Which growth stocks should you buy in the year ahead? Coming up, we'll tell you about 7 stocks a top strategist is watching, from tech names to cyclical growth, and he'll explain how you can take selective risk as we deepen our move into this bull market. So let's get started. This is Ticker Take.
John, after the big run-up in growth stocks, some people might be starting to feel a touch guilty for wanting more.
Should we make our guilty faces? It's true, Caroline. Sometimes this is the psychology of the investor. Big run-up, you feel guilty for wanting more, but should you? Especially if growth has been a friend to investors, and if you end up, through that guilt, taking that money, investing in something else, and then ultimately you're disappointed with that.
Yeah, so we spoke to Citi strategist Drew Pettit.
Yes, because Drew is still leaning into the idea of growth performance in 2026. He's just looking at it through smart decisions on individual stocks.
Yeah, and before we get to those 7 stocks, let's hear from Drew to better understand his thinking.
Drew Pettit, thanks so much for joining us.
Oh, thanks for having me in.
So the stock market has had this great run, and as you have said, a lot of stocks are not cheap. But the bigger question you're exploring is whether or not that means risk is a bad word. So where do you land on that?
Yeah, it's funny. I'm going to unpack this a little bit. Let's start with cheap. And, you know, in a bull market, if something's cheap, it's normally cheap for a reason. So if you don't have cheap, then you have risk. Look, there's a reason we say risk and reward. To have a reward, you got to take some risk. So to us, risk, beta, not bad words.
Okay. So that means that you're still looking at growth opportunities, but on that word risk, like your theme has been selective risk. And we're going to go through a number of growth names that you're watching, stocks for 2026, some tech names, some cyclical names as well. But before we get into that, give us a sense on your analysis. Like, how do you decide what could be worth people's investment dollars?
Yeah, so when we look at the market, there's 2 types of growth, 2 types of risk I want to take. So that traditional techie type of growth, we like AI, we think that's real, productivity enhancement, real trends, real themes. But I want to be careful when I'm in that space because things are either expensive or the growth expectations are really high. So I got to make sure companies can grow into it. On the other side, that cyclical growth, people haven't believed that story. They could be worried about the economy. I want to make sure that those companies that have been under pressure finally do have that growth. So on that side, it's show me the growth. On the other side, it's keep giving me the growth.
All right, with all that said, let's get to Drew's 7 stocks. But first, a friendly reminder, this is not financial advice. Stock number 1, Boston Scientific.
Okay, well, Drew, we're first going to be going through some of the names that have more of a techie feel. I wouldn't call this a tech company, almost like a healthcare tech if you were going to call it tech, but they are an innovator, and they do bring innovation to the medical world. And Wall Street loves this company. So give us your take on Boston Scientific.
So this is a company, again, medtech field, surgical products as well. Look, the product portfolio is expanding. It was just cardiovascular devices. Now they're doing more in like the medical surgical areas. And what they're developing is hitting. So it's not just the old product. It's not just, the old ones gaining share, getting uptake, but you're seeing good, I would say like low double digit organic sales growth. You're seeing margin expansion of like 100 basis points. And look, it has operating leverage. So you're growing that top line 10%, you're growing the bottom line 10, 15, 20% when you look out 2-3 years from here.
Stock number 2, CrowdStrike.
Well, it's interesting, Drew. It's been about 1.5 years since this company had the outage heard around the world, but they have bounced back in a big way from that. They had momentum before they were dealing with that. What stands out to you about CrowdStrike?
So it's funny. We didn't like cybersecurity as a theme. It lacked a lot of operating leverage. And you talk about that outage in a name like CrowdStrike, everyone talked about tech adoption, advancement. Oh, that's good. They'll develop more products, but bad guys have tech too. So it was a never-ending investment cycle. What's changed here and changed our thinking on CrowdStrike is they're finally developing more products that are being taken down by clients. So there's this trend in the industry where there's consolidation of vendors. So CrowdStrike, a leader in the space, making new products people like, creating agentic AI solutions for customers. They're growing that base. They're growing earnings. They finally have some operating leverage and margin expansion. That's why we're coming back to CrowdStrike, even though we haven't really liked cybersecurity for some time.
Stock number 3, Uber.
Well, coming into this year, Drew, we had a number of guests who saw upside for Uber, and indeed it ended up having much better performance over the course of the year versus the S&P 500. When you look at the analyst community, a lot of them are still quite constructive on Uber. What's your take on the company?
You know, it's funny. It's one of those stocks that people like it, but it's getting challenged by the Teslas and Googles around autonomous vehicles and driving. But when you really break this thing down, the platform's growing, the investments they've made, not just in drivers and adding delivery, adding grocery and retail, these add-ons to the product have actually all been accretive to margins. So margins are expanding. So this is a company that, you know, has EBITDA margins of, let's call it 6% today. That could be 15, 16% in a few years from now. So really good investment in what they're building out. And I think some of this competitive talk right now creates a buying opportunity in Uber.
Stock number 4, Nvidia.
Drew, perhaps the most talked about stock in the world. And I guess, you know, in sticking with this theme of, wow, stocks have had a big run, what happens next? I feel like people can't help but wonder that about Nvidia. So where does it fit into your thinking for 2026?
So when we talked about risk in the open, the Mag 7 risk for next year is they're going to act more idiosyncratic from one another. NVIDIA is not going to be like a Tesla or a Meta. They're all going to trade a little bit different on their own fundamentals. When we really think about NVIDIA and what we want to own out of that cohort, this is the one that gets the best return on their CapEx dollars. Top of the heap, best of all the growth stocks in the United States. If you're going to stay in mega cap, here's where you want to be. We're talking about a company with 80% gross margins, an accelerating top line. They're printing money, they got cash, and this company over time can pivot. They can follow whatever theme is going to drive better returns for investors. So NVIDIA, still top of our list out of the Mag 7.
Stock number 5, Teradyne.
Okay, now, Drew, we're moving more into the cyclical names that you wanted to highlight. This is a company known for a few things, including testing computer chips. Now, it has had a nice run. So what is it about their business that catches your eye?
So it's funny. It is a tech company, but people kind of forget that semiconductors outside of NVIDIA are really cyclical businesses. There's ups and downs. So the stock has run ahead of the earnings growth inflection. We're looking at a stock that's maybe had $2 to maybe the high $2s, $3 in earnings over the past few years. That looks like it can double in the next 2. They're catching an upswing in the semiconductor test cycle, and they're finally catching on to some of the AI tailwinds that have already played out in a lot of the bigger semis. So when you think about this looking back a little bit further, you got a better value stock relative to some of the bigger names, finally catching the growth tailwinds. It's a way to kind of diversify your semi exposure into cyclical semis.
Stock number 6, CoStar Group.
Okay, I'm generalizing here a little bit, but known for data tied to the real estate industry is sort of a core component of what they do. I would argue it's been out of favor. And then in recent years, maybe you could even argue choppy. But over the long term, one of the things that always stood out to me about CoStar was it was a real long-term winner. So when you look at the business overall today, what do you see?
So challenges from AI, that's been the big story around CoStar. And that's why you've seen the choppiness in the past year. We push back on that. So the key here is AI needs data to kind of feed the process, right? CoStar owns the commercial real estate data. They have tons of apartments and rental data and home price data. This is where they actually have a moat. So while the AI challenge to the CoStar story has beaten the stock up, it still has a moat around data. And when you look at the business, again, tons of operating leverage. Data isn't hard investment. It's not big capital expenditures. So again, an upswing in the real estate market ends up really benefiting these guys because that data is valuable. So to us, it's a name you buy that's been challenged, but the business still strong.
And stock number 7, Regal Rexnord.
Okay, here we have a company we've actually never talked about on Ticker Take before, so we appreciate you shedding some light on it. It is a company that makes things people might not know too much about, but they would know more about the machines that their products go into. And I was amazed to see how liked this stock is on Wall Street. So what can you tell us about it?
Yeah, it's funny. It's a stock that really hasn't done well because of tariffs. So they're into motors and automation components, complex manufacturing, a lot of parts sourced globally. So tariffs have been a hit to EBITDA margins. So that's been a struggle. That's in the past. So forward looking, we're looking for EBITDA margin expansion, and they're finally getting some tailwinds from bigger infrastructure build out and even data center. So the top line accelerating, EBITDA margins stabilizing, and we're looking at a stock that now earns $9 in earnings per share. That could grow to 14 in just a couple years.
Drew, great, interesting, fascinating list of growth names to watch in the new year. We appreciate your time.
Oh, thanks for having me. Really appreciate it.
All right. Our thanks to Drew Pettit. You can learn more about him in our description.
Where we've got other ways you can connect with Ticker Take, from our podcast to the investing newsletter that we make available for free.
Don't forget to subscribe so you don't miss our next investing video.
See you next time.